one of the very big questions right now also, considering that a lot of all these AI and tech names have already rallied for quite some time, a lot of people always ask, so Adam, still can buy or not?
The answer is...
Alright, so I'm extremely excited for a special episode, and we have finally gotten Adam Khoo, who's the founder and also the chief trainer of Piranha Profits on to our PP channel. So let's give a round of applause. And also, I think many of you have requested for Adam to be on the channel in the comments below, and everybody's asking, where's Master Sifu? Where's Master Sifu? So, as always, don't forget to subscribe to this channel, and I've made a private pact with Adam. This is his first and last appearance until the channel hits 30,000 subscribers. So if you want to see more of Adam on this channel, please subscribe to this channel. But anyway, I think a lot have happened over the last 1 year, 2 years or so, and I think we have just managed to track your results. And I think over the past 5 years, Adam have actually beaten the S&P 500 for over 1.5x, where the index actually did close to 120%, while Adam, your portfolio did more than 180% in that same time period. So it's particularly impressive because Adam has been sharing a lot of his discussion points and his investment portfolio specifically, and he's quite diversified in a way, where he has more than 50 stocks and ETFs in your portfolio currently. So maybe
more than 40. Less than 50, but more than 40.
Yeah. So I think I just wanted for you to share with the audience on what's your learning points and how did you come about constructing a portfolio and beating the market over the last 5 years?
I think over the last 5 years, I would say that it's one of the most challenging 5 years that I went through. It's a lot more challenging than the previous 5 years. Because the last 5 years, as you know, we went through 2 big bear markets in 5 years, which is very rare. We had a recession, we had a regional bank crisis, we had a pandemic, we had the fastest interest rate hike in history, we had the highest inflation in history. So it was a very challenging time. And I think the lesson would be more of reinforcing what I already knew, being in the markets for so long, but really reinforcing to all the students that, see, it works if you hold on to high quality companies. People are always afraid, oh, what if the market crashes? What is the recession? Yes, these things happen. You never know when they're going to happen. No one could have predicted COVID. No one could have predicted the inflation. Not even the Fed could predict inflation, right? But the whole point is that if you hold on to great companies that make money consistently, then you don't worry about all these kind of things. Because all these things that happen, yeah, the price will go down, but it's temporary. And you take advantage of that temporary discount to build more, and your portfolio grows even more when the event is over. So I think that was one lesson that was reinforced to everyone. And I think the second lesson that was reinforced is the fact that don't listen to economists and don't listen to market analysts. Why? Because if you recall, when COVID hit in early 2020, and March we had that big crash, that very fast crash, right? And at that time, majority of economists and analysts were saying that it's going to get worse. This is going to take years to recover. Very few people said that the market was at the bottom. In fact, I don't think anyone said that, right? And when I said that the bull market has started in, I believe, early April of 2020, and I shook that Coke bottle, a lot of people thought I was insane. All right? And they say, Adam, cannot be, because all the economists saying that we're in a depression, we're in a recession, job losses. And I said, don't listen to these people. All right? And sure enough, the market had the strongest rebound in its recent history. So, and then what happened in 2022? In 2022, everyone, well, most people, even the economists, predicted that we're going to have a recession in 2023. In fact, they say it's a 100% chance of a recession in 2023. What happened? No recession. And if you had listened to these people, you wouldn't have made any returns. And if you had shorted the market, you would have gotten killed. So I think that reinforced what I've always told people, that never listen to economists or analysts, because no one can predict the market. No one can do it. I can't predict the market. They can't predict the market. The whole idea is to stay invested in high quality companies. I think those are the two things.
Actually, on the side note, right, Adam, can I ask you, why are you always so optimistic about everything in life? Like, I think in your own business and even in the stock market, right?
Yeah.
A lot of people actually do seek like solace and to find you for a source of optimism, especially when, like you said, every time you go on CNBC, you go on YouTube, you have all these, everybody is on fire, everything is on fire, there's a recession and all this stuff. Can I like understand a little bit more on that?
Actually, it's very interesting because, on one hand, I'm a long-term optimist.
Right.
At the same time, as you know me better now, that I'm very cautious. That to me, my priority is never profit maximization. It's never profit maximization. It is capital preservation.
Right.
That's why if you look at my portfolio, I'm very diversified. I don't just have growth stocks. I've got a lot of defensive stocks. I've got dividend stocks and so on and so forth, right? So I think it's having that combination, because if you're too optimistic that, everything will be fine, market will always go up, you take too much risk. You leverage, you over concentrate, and then when the crash comes, you die. Okay, so you don't want to be over optimistic, but you also don't want to be over pessimistic. Oh, we're gonna die tomorrow, we're all gonna die. And then you don't dare to buy anything. So it's always striking a balance between the optimism and the pessimism. So it's the old saying that expect the best, but prepare for the worst every single day. And I think one of the reasons why I'm long-term optimistic is not because of blind faith. I don't believe in blind faith, right? But I look at history. I look at statistics. And as you guys know, I love looking at statistics. If you look at the last 120 years of the US market history, there's always something to worry about. You have 2 world wars, you got a Great Depression, you got financial crisis, you got all these things happen, but the market goes up eventually. Why? Because it's like Jurassic Park. Nature always finds a way, right? But in the financial markets, business always finds a way to make more money. Yeah. So in the long run, corporate profits on aggregate will always grow because of inflation, productivity, higher wages in the long run. And in the US economy, on average, US corporate profits grow about 8% a year. So does that mean the US stock market grows 8% a year? No, because besides that growth in corporate profits, you have got share buybacks, you got money supply increase, you have got dividends. So all this allows the market to grow an average of 10% a year if you just invest in the market, right? But by picking the highest quality stocks with the highest earnings growth, highest return on capital, we can 1.5 or 2x or even 3x that in certain points of time. Register for Beat the Market live online event, where I'll be sharing my latest market insights and stocks that I'm watching. Plus, my fellow mentors will share trading strategies that you can use to beat the market this year and the years in the future. Fast action takers will also receive my latest market analysis report and exclusive investing ebook. Spots are free and highly limited, so click on the link in the description below and take action now.
Thanks for sharing. I think I just wanted to go back a little bit in time. I think just roughly a year ago, where we had our mid-year event for Piranha Profits, the main theme of that idea back then was the sixth wave. So maybe you just wanted to give a quick recap to our audience on what was the sixth wave and how did you maybe chanced upon that idea.
Okay, so the sixth wave is actually what we call innovation waves that I didn't invent. It was invented by some professor in the university. I can't remember his name, right? So what he discovered is that over the long run, every few decades, every 30 years, there's a new wave of innovation that changes the world, that changes our lives, that changes businesses and the economy. So we are right now in the sixth wave. Okay. So to give you an example, the fourth wave was 1960 to 1990. So it was about 30 years. So the fourth wave was the invention of electronics, the first desktop computer, petrochemicals, right? So it was those companies like ExxonMobil, like again, it's so old that I can't remember, right? But all those old companies, right? IBM, that really led the market at the time. Then after the fourth wave, and I was too young to take advantage of the fourth wave, right? So I made my money in the fifth wave. So the fifth innovation wave was 1990 to 2020, that 30 years. So the fifth innovation wave was driven by the invention of internet. The internet was invented. And then came about software. Then came about mobile, which was the iPhone moment. That came about social media. So I ask people this question: did social media, the mobile phones, did it change your life? Did it create new businesses? Did it create new jobs? Did it change the world? Yes, right? And during that fifth wave, the S&P 500 grew 1,950%. That's over 10% annualized a year if you just buy the index, right? So if you know how to pick the best companies that led the fifth wave revolution, you would have gotten 15, 20, 25% return a year. So I made my fortune in the fifth wave. I think so did many of my older students. Some didn't. Some missed it because they were too busy listening to all these doom and gloom economists, right? So the good news is that if you missed the fifth wave, if you didn't make money in the fifth wave, or you were too young in the fifth wave, now we're in the sixth wave, all right? And you notice that every subsequent wave becomes more powerful. The market goes up even faster in every subsequent wave. So in 2020, we have started this sixth innovation wave, which is what we call the new industrial revolution driven by AI, the Internet of Things and automation. To me, I think that the next 10, 20, 30 years would be the biggest impact on the economy, on businesses, and on the stock market.
Specifically, was there a light bulb moment when you came across this theory and then you're like, this is going to be the next big thing?
So when I did my research on that, and I think the thing that sparked it all off was the ChatGPT moment. When we were like, the first time we were introduced to ChatGPT, I was like, my God, he can write a poem for my wife in less than 1 minute.
Right.
With ChatGPT, I can now do research on companies. I used to take hours to research a company, to do a SWOT analysis, and this ChatGPT can do in 1 minute. And that was a light bulb because I realized that it's going to increase our productivity by 5x, by 6x, which means companies are able to do so much more with less resources. That increases their productivity, reduces their costs, increases their profits. And I said, my God. And I think, I can't remember who said it as well. I think it was one of the founders of Google. He said that the AI revolution is as significant as the discovery of fire and the invention of electricity. So if you think that electricity changed the world, you think internet changed the world, this AI will be even bigger.
Right. And I also believe that, I think during the webinar the other time, during the sixth wave, you were basically banging on the table and telling people that, hey, it was not financial advice, definitely, but you were floating some of your strongest conviction, like Amazon, like Google.
Yeah.
And back then, this AI idea was still quite nascent in a way, because I still remember back in like mid-year of 2023, I think GPT came out in end of 2022. And then it took some time. Then everybody within the next 3 to 4 months was talking about GPT.
Yeah.
But we were still quite early, like in the early innings, not as much as today. Like maybe looking back 1.5 years after GPT is introduced, right? Was there like, what was your conviction, especially when now these AI talks are so new? Everybody was just like, oh, they're still in confused, like a confuzzled state. And then you were saying that, no, this is the way to go. I just wanted to know where was that source?
Actually, at that time, even without AI,
Right.
Amazon, Google, Meta were dirt cheap.
Right.
Even without AI. So AI to me was like a nice bonus. So I was not banking on AI to get these stocks to rally. No, not at all. So in fact, I did a few videos on Amazon. I did a 2-part series on Amazon, said Amazon's gonna rule the world and stuff like that, right? So if you actually do your deep dive research into these businesses and you really understand their business model, their dominance and their growth, and you do a valuation, you realize they were dirt cheap. They were so dirt cheap, it was ridiculous. Like I kept saying that time, Amazon is over 50% discount. This was over a year and a half ago. Google's also 50% and Meta is like 80% discount. But some people, they didn't realize it because they don't understand how to value companies. That's why, to me, as an investor, the most important thing is to know how to value a business. That is the most important ingredient in the secret sauce. And the trouble with most retail investors is, how do they value a company? They just look at PE. The PE is very high. You cannot buy. I buy the low PE, right? But you know, and we've done a lot of videos to show that PE is one of the worst ways to value a stock because there's a lot of limitations. And there's an old saying that says trying to value a stock using PE is like trying to guess someone's weight by looking at their shadow. Okay, so it's very misleading. Someone skinny can look very fat in the shadow depending on their angle. Okay, so a lot of people didn't buy NVIDIA. Why? PE is too high. 1 year ago, right? And I think NVIDIA's PE was, I think, what, over 100 PE? But I say, no, it's cheap. Okay, because you cannot look at the PE. You have to look at free cash flow. You have to look at the free cash flow growth and all that stuff. Yeah.
I think one of the very big questions right now also, considering that a lot of all these AI and tech names have already rallied for quite some time, a lot of people always ask, so Adam, still can buy or not? I think in the comments on whether is it on our channel or on your channel, it's flooded with this kind of comments. So the final question, or the $1 million question is, Adam, still can buy?
The
Whether all this
answer
tech-
is, I will reveal it during our event,
Right.
our mid-year event coming up.
Okay. Maybe you want to give a sneak peek on what you're going to be sharing during the event itself?
Yeah, so I'll be talking about the market. Where's the market right now? So some people are saying the market's in a bubble, it's gone up too much. So is it really in a bubble? We're going to do a deep dive into understanding the market and looking underneath the hood of the S&P 500. So yes, within the S&P, there are stocks that are very overvalued. Yes, there are, okay? But there are also stocks that are very high quality, that are growing like crazy, that are not that expensive. And you'd be surprised which ones they are. I'll talk about it during the event. And there are also some high quality stocks that have been left out of the bull market. They have been ignored, they've been unloved, but they're great companies simply because there's no AI in them, but they are doing very well. So there's an opportunity to both buy the AI related companies, some of them which are still fairly priced, and there's also an opportunity to buy the non-AI companies that have been ignored by the market. So we'll talk more about that during the event. Because remember that AI is not everything. Every day in our lives, we still, like this morning, I had McDonald's for breakfast, right? That's not AI, right? I had a Coke yesterday. That's not AI, right? We went to Lululemon to buy some more jackets yesterday. That's not AI, right? So there's a lot of great companies that have been
Okay.
missed in this bull market.
Right. I think maybe since a lot of people have been talking about AI, and AI is consuming the entire mind share of the entire stock market right now. I think in any financial publishing related companies, everybody's talking about NVIDIA. So I think I just wanted to go back in time because you shared a very interesting tweet or X post, whatever it's called right now, and it garnered quite a lot of engagement and a lot of people asking you a lot of questions. So maybe I'll just, in a way, confront you on your own journey with NVIDIA and talk a little bit more. So just a background for some of you who don't know, we'll leave the link to the tweet itself in the description below. But anyway, I think for Adam specifically, he first bought into NVIDIA back in October or November of 2022, and you bought in at an average price of around $150 per share. But after split adjusted, it's roughly around $15 today because they did a 10-for-1 stock split. Then right after a few months, you actually sold a covered call on NVIDIA at a 350 strike. So that's almost more than double. And you sold at an average price because your shares essentially got caught away of roughly around $380 per share. So that's $38 split adjusted. So, and then after that, thereafter, after a few months, you realize that the AI revolution has begun. You recalculated the intrinsic value of NVIDIA to be right around $400. And back then, but the stock was worth at around $490, but you're willing to pay a premium. So then you bought back the shares, and subsequently you did two more revaluations. In Feb of this year, you revalued to $680, and of June of this year, you revalued it to over $1,000 a share. So then you also shared a few lessons, which maybe you can expound a little bit on. But I think before we go through this whole process of you selling and then buying back again, I just wanted to ask just a very curious question on how did you actually first discover NVIDIA as an investment opportunity? Like, was it someone that told you?
Actually, I was looking at NVIDIA for many years. For many years already, right? And I wanted to buy it for a long time, but it was too expensive to buy. And at the time when I was looking at it, it was not an AI company. There was no AI. It was a gaming company, and they were leader in GPUs. So my intrinsic value initially for NVIDIA, this was before the share split, right, was about $220. And it was selling way above that.
Okay.
So I was waiting to buy it for a long time. And then in 2022, when all the tech stocks crashed and it went to 150, I said, here's my chance to buy it. So again, at the time when I bought it, I knew nothing about it being an AI company.
Right.
It was still a gaming company. Yeah.
But I think I also remember back then for NVIDIA, right? On top of the gaming part, there was this initial rally because of Bitcoin. Like it was used for mining of Bitcoin.
Yeah.
And then it crashed because the entire crypto space also went to a winter.
Yeah.
Was that even part of your consideration when you looked into NVIDIA back then?
Oh, yeah, so they benefited from the crypto boom.
Yeah.
All right. So in fact, that was one of my concerns when I bought it. Whenever I buy a company, it's always what's the risk of the investment? Right. And as you guys know, I'm not as bullish on crypto as most people. So, but again, I said to myself, even if the crypto doesn't work out, I think they can still do very well on the gaming front and on the data center front, even without AI at the time.
Right. Then now I wanted to ask, so when you bought NVIDIA at such a low price, right, what was the trigger point on why you wanted to sell a covered call on NVIDIA back then when it was around 350?
Okay, so when I bought it at 150, like I said, my intrinsic value was 220.
Right.
Okay, so when it went to 300 plus, it was really overvalued.
Yeah.
And when you look at the chart was going 90 degrees.
Right.
So whenever the price goes 90 degrees, parabolic, and it's overvalued, it's like nothing wrong with selling it. Okay, so I did something called selling a covered call option, where I get paid premium, but I'm obligated to sell the shares at 350.
Yeah.
I then rolled the call up to 380. And of course, now looking back, it was a really dumb thing to do, okay? Because I knew from years ago to never sell covered calls on growth stocks. I already knew that, okay? But I broke my own rule. And so that shows you that, you can be in the markets for many, many years, but you can still do stupid things. And that was a stupid thing I did, which was selling a covered call on a growth stock, right? Even though it was overvalued, even though it was overextended. Yeah.
Then on the second phase now, you sold and then you bought it back.
Yeah. So in the end, my shares got called away. So in the end, I sold it all at $380.
Right.
Yeah. And after I sold it at $380, it kept going up. Then it went up to 480 something.
Yeah.
And most of the time when that happens, it's like, I have no regrets. Like, okay, fine, whatever, right? But in the case of NVIDIA, I did a revaluation. Now remember that our intrinsic value calculation is based on free cash flow. Right? It's not based on stories like, oh, maybe they can do this. It's not based on hype. It's based on numbers.
Right.
Okay? Some people, they like to value stock based on stories. I don't like to do that. Okay? Because a story is just a story, right? Now, I must say NVIDIA is a very unique stock. I've never ever seen a stock like this before, where the next earnings report, the free cash flow can jump by 300%.
Right.
I've never seen it before. Never in my entire life. So when the new earnings report came up and the new free cash flow was announced with the new growth projections and the new total addressable market, I did a revaluation and I found that it was worth 400 plus. So, and I was willing to pay a slight premium for it because I was so mesmerized by the chat GPT that I was using that even I felt that my valuation was being too conservative. That I thought that if things really play out, like the sixth wave, then NVIDIA could have been worth $500-600. So at 4 plus, I said, let's buy it back.
Despite the premium.
Yeah, because I knew, okay, so the premium is because I did a conservative valuation. But if I put in the growth, which I thought it could possibly achieve, then I thought then 480 could still be really cheap.
Maybe also, I think some of us, actually, we probably all have some sort of a similar encounter where we sold the stock too early and then there's some level of anchoring bias, Like, I could have bought it at 150 the other time and then I sold it at 300 and then it's 400 plus. I just couldn't take it. I cannot press the buy button because I just feel very stupid and lousy. So maybe do you have any framework or mental models into convincing yourself that how do you go past that hurdle or go past that?
Yeah, you're right. A lot of people have what we call anchoring bias, right? So they bought a stock at 50, they sold it at 100. They can't bring themselves back. They can't bring themselves to buy
That much
higher than what I think that's the Chinese or the Indian blood in us. We cannot pay more, right? Okay. So my trick in trading and investing to get out of anchoring bias is to imagine that I've got dementia.
Okay.
Right? And one of my favorite shows is Finding Nemo, and he had this fish called Dory.
Right.
And Dory had a 5-second memory, right? She forgets what happens 5 seconds later, and she's like, just keep swimming, just keep swimming. So every time I'm trading or investing, I adopt the Dory mindset where I've got a 5-second memory. I can't remember what I sold it at yesterday. I can't remember what I bought it yesterday. I just care what is the share worth today.
But I think also on the flip side, some people might be worried that, especially when the entire... I mean, a lot of people have been saying that NVIDIA is overvalued since 400, 500, and then even until 1,000 plus before the split. And they are trying to combat themselves or tell themselves that, oh, I don't want to feel FOMO. I don't want fear of missing out. And they're very scared of this issue. How do you make that judgment, or how do you weigh or balance that?
So it's all based on valuation. So If you think a stock is worth $50 and it's selling at 60, 70, 80, then obviously you don't buy it. You don't buy for the sake of the emotion or what if it goes higher, right? But if you know the stock is worth 100, based on your research and your valuation, based on numbers, again, not based on story, and it's selling at or below 100, then to me that's not FOMO. That's buying something of value. It's all about valuation. So the question is NVIDIA cheap or expensive today? It depends on the valuation, which depends on the growth assumption. So it's all about your growth assumptions.
Right.
If you believe that AI is just at the early innings and AI would transform finance, healthcare, farmers, if you believe all that, NVIDIA is still cheap.
Okay.
But if you don't believe that, you think, no one's going to use AI, then NVIDIA is expensive.
Right.
So do you believe that? It's up to you, right?
In terms of expectations. And then after they execute, you will see the free cash flow continue going.
Yeah,
parabolic.
because right now they are 80% market share of the high computing chips market.
Right.
And they've built a very strong ecosystem moat that is very hard for anyone to replicate. So I think there's no question about the moat. I think the question is about demand for the chips and the demand for AI. Is it a fad or is it something that's going to change the world? So you have to answer the question.
Right.
And again, I could be wrong. I'm not saying that I'm right. So far I'm right, but could I be wrong tomorrow? Sure. Okay. But the great thing about investing is you can be wrong many, many times and still make a fortune. Why? Because of diversification. Now, I've got over 40 stocks. Okay. So far I've been wrong on Alibaba. Okay. So far. Okay. All right. But maybe we'll be right one day. Okay.
Right.
And so far I'm wrong on Estee Lauder. So I've been wrong on a lot of things so far. Okay. But despite being wrong on a few things so far, I'm still building my portfolio because I'm diversified. So the whole point is that as long as you're right more than you're wrong, you make a fortune. And you know that in investing, you don't even have to be right more than you're wrong. Even if you're right half the time, you make a fortune.
I think especially because when you're so-called wrong, in a way, when the stock price don't move in your favor, the maximum you can lose is the amount of money you put in, right? But when you win, like especially NVIDIA or this multi-bagger stocks, they more than cover many of your so-called wrong decisions and your hit rate might.
Yeah. So think about it, right? So if you bought 10 stocks, for example, you can be wrong on 6 stocks and still make a fortune. Because the 6 stocks that you're wrong, at the most you lose 20% each or 50% each.
Yeah.
So what? But the 4 that you're right, like an NVIDIA, ASML, Microsoft, Google, and Amazon, these guys will go up 5x, 10x. So that 5 to 10x more than offsets the 20-50% loss of the 6 stocks, you still make a fortune.
Right.
So like what George Soros said many years ago, I remember when I read his book, it's not whether you're right or wrong that's important. It's how much you make when you're right and how much you lose when you're wrong. And investing is a very forgiving business. It's a very forgiving business because if you're wrong, the most you can lose is 20 to 50% of your money. To lose 100%, very rare. Unless you buy something totally worthless, right? Which is unlikely if you follow our rules. But if you're right, you make multiple fold. Yeah.
Right. And we talk a lot about the revaluation process, right? Can I also just ask on the side, how often or how usual do you revalue your entire portfolio of stocks?
So I have to revalue every stock every month because of the Ultimate Investors Playbook UIP subscription. We've got thousands of people that subscribe to UIP, where every month I have to revalue the stocks for all of them to see and to recalculate all the buy levels every month.
Right.
But if I didn't have this UIP subscription and I was doing it on my own, I'll probably be more lazy. I'll probably revalue it maybe once every 6 months.
Okay.
Once every year. But because of the subscription, I have to do it every month for them. And in a way, it's also good because it forces me to keep revaluing the stock. Now, I must say that for most stocks, 99% of stocks, the valuation doesn't change that frequently. It changes maybe once a year. NVIDIA's valuation can change every 3 months.
Right.
But it's very rare. Okay. NVIDIA is one of those very rare animals that you see.
Okay.
So don't expect every stock to be like that.
Right.
Yeah.
Okay. So maybe I think, thanks Adam for sharing. I think we have gone through quite a lot. So maybe just an ending note, right? I know that you have recently also Adam always posts very engaging content on his socials, so do follow him. But he recently posted this very interesting discussion points. He did say basically our thoughts on the market today, and he said that it looks slightly overextended and it's a seasonally weak period going into late July to even August. So I just wanted to ask, at least on your front, are you specifically doing anything special? And because I think there was a few discussion points that you said on when should you start quote unquote selling your stocks, especially when you're on margin, when you need more cash, or you need more dry powder or raise more dry powder in overextended market. So just wanted to know, are you doing anything special in this time?
I'm not doing anything special. I'm doing the same thing, except taking new option trade positions. I'm a bit more cautious.
Okay.
Not so aggressive, but if I see a setup, I will take it. But I'll make sure I don't have too much overexposure, especially when it comes to late June to August, when the market seasonally tends to be more bearish. If I see a great company that is cheap, I'll still buy it today. It's not that I won't buy, I'll still buy it today. But many of the great companies that I want to even add more on, whether it's Google or Meta and all that, right now I'm not buying because, again, even on an individual stock level, although the valuation is not super overvalued, but the chart shows it's a bit overextended. So I keep talking about the wave patterns, right? Stocks move in wave up, wave down. Right now it's like on a wave up pattern, and it's waved up quite a bit. So my discipline is always wait for a wave down to start accumulating.
Right. Then can I also ask on your personal portfolio level, how much percent is a good rule of thumb to keep as dry powder to take advantage of the next wave down?
Right now, I've got about 5% of my portfolio in cash.
Okay.
Right now.
Okay.
Yeah.
Do you kind of, is that a rule of thumb? Or
It depends on where the market is. So if the market has dropped significantly, the cash should be zero. It should be fully invested.
Right.
But if the market is getting a bit overextended, then you could go into maybe 3%, 5% cash.
Okay.
Yeah. So it really depends. So for most people who are working, every year you should spend less than you earn and have some savings to put into your portfolio every year, right? So if you're someone who puts money into your portfolio every year, it's okay to not have too much cash in your portfolio because you keep putting money in anyway. But it's for people who, let's say, retirees, they got no more money to put in, that's all they have in their life, then yeah, at this stage when the market is a bit overextended, nothing wrong with selling some stock to build up some cash so that when the market eventually corrects down, which is inevitable, you got some dry powder to take advantage of it.
Right. And also on an age-old question on this whole idea of, if you are already expecting a pullback, should you even bother hedging your portfolio? Whether is it being market neutral, short some positions, or close some positions, or use put options?
Yeah, so I mean, I've been doing this for 30 years, and the first 10 years I was an idiot doing all the dumb things. Last 20 years I was a bit smarter, but still doing some dumb things once in a while.
Okay.
And yeah, so in the past I used to do this. In the past, every time I felt, okay, market is getting a bit overextended, let's go and hedge. So I buy a lot of put options and I'll do all kinds of hedging and stuff like that, right? And what happens is that, yeah, once in a while, when a market really drops like crazy, you make money on the hedge. Your put options make a lot of money. But that is not very often. Most of the time, when you buy your put options, you're hedging, it keeps going up. And then your puts all lose money, right? Or it drops, but not enough. Your puts, before they can make enough, it flies up again. So I realized that after doing this for so many years, that at the end of the day, it's not worth doing it. It's not worth the time, right? Yes, over the years, I have made money in hedging, but it's so negligible that it's not worth doing. So today, I don't bother hedging because I realized that it is really not worth doing it. Unless if I confirm it's a bear market, then I will hedge. But even then, it's also not necessary. Okay. I'll give you an example, right? So in 2020, when the COVID started and the market started coming down, I bought a lot of put options to hedge as well. And when it went down, I made a lot of money on my put options. But then it rebounded just as fast, and all the money I made from the put options also all disappeared in the end. So it was like, it cancelled off. So I might as well not have hedged.
Right. I think thanks, Adam, once again for coming on. And if you guys have any questions, feel free to leave in the comments below. Maybe we'll pick up some of them and ask Adam in the upcoming Beat the Market webinar as well. If not, if you guys thoroughly enjoyed yourself, please help us smash that cute little like button.
Like, subscribe,
and share this with all your friends and families. And with that, as always, this is CK from Piranha Profit signing off. Till next time, keep winning.